Good morning, and welcome to today's Moss Adams webcast, Q2, Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to acknowledge our big news from last week, that Moss Adams is joining forces with Baker Tilly to create a new firm, one designed to serve the needs of the middle market. It's really exciting, and you can read more about it on our website via the link posted in the slide deck and handouts widget to the right of the slide view. With that, I will turn it over to Dominic to get us started.
The Dow was down just shy of 1%. Tech-heavy NASDAQ and small caps were laggards, both down 10%. But on the bright side, bonds were up just shy of 3%. The 10-year Treasury dropped from nearly 4.6 to 4.2%. During the first quarter, though, volatility hovered around a fairly normal level of 16, but began popping into the low 20s near the end of the quarter. So if we stop there, things didn't look so bad. Kind of a run-of-the-mill pullback in the greater markets and a correction certainly in technology and consumer discretionary names. Yields fell a bit, which is what we expected, and volatility, as much as it felt like it wasn't, was largely kept in check. But then Liberation Day and the administration, dubbing that April 2nd, made an appearance and kind of felt like all hell broke loose. And it's been quite a ride since. So with that, Michelle, can you give us a bit more color on what's actually happened with the markets so far this year and why?
Yeah, Dominic, so it's been a volatile start to the year for sure. The U.S. stock market began 2025 with strong momentum, driven by economic growth, pro-business policy expectations, and advancements in artificial intelligence. The market breadth improved a lot coming into the year as the labor market held strong and inflation continued to retreat to acceptable levels. The S&P 500 hit a new all-time high in mid-February. However, a rapidly evolving and at times chaotic stance on tariffs heightened trade policy uncertainty and hit consumer sentiment late in the quarter. And despite robust corporate earnings, the first quarter ended down, as Dominic said, 4.3%. Then as we turn the corner to April, U.S. stocks suffered the largest one-day decline since 2020 following President Trump's Liberation Day announcement, subjecting imported goods to sweeping new tariffs. The S&P 500 declined more than 10% in the 2 trading days following the announcement, falling squarely into correction territory, which is a decline of 10% or more from peak values, and coming just shy of an official bear market, which is usually measured as down 20%. The main concerns were one, the announced tariffs were much larger than expected, and two, fear that a quick onset would lead to immediate cost increases, while potential benefits such as reshoring industries and potential tax cut legislation were farther down the road. In addition to the severe reaction in stocks, there was a surprise liquidation in longer dated treasury bonds, and yields gapped higher on the 10-year treasury. Hard to know if the markets were the influencing factor, but on April 9th, President Trump backed off his tariffs on for most nations for 90 days, with the exception of China. A serious relief rally ensued, and S&P 500 rose 9.5% for the day, its sharpest single-day gain since October of 2008. However, the volatility was far from over, of course, and the administration is now in negotiating mode, with the markets awaiting deals. So, Dominic, can you give us the details of the tariff plan and what we've heard from the administration since?
All right. And so far, the theme for this year is certainly uncertainty. The second Trump administration has made trade policies a priority from the get-go this time, but the lack of any certain way forward is what has roiled the market and kept investors on edge. Here's what we know, and stick with me. So February 1st, we get the first official announcement. 10% tariffs on China, 25% tariffs on Canada and Mexico. And the administration also hints at more tariffs and more countries to come. China and Canada retaliate immediately. Then 2 days later, the U.S. takes a 30-day pause on Mexico and Canada after some negotiations on border controls. February 10th, 25% tariffs on steel and aluminum are announced. Then on March 4th, the 30-day pause is up and tariffs take effect in Canada and Mexico, and double in China. So Canada and China both hit back immediately again with more tariffs. Over the next 30 days, steel and aluminum tariffs both increase, and Canada and the UA start to weigh in with countermeasures of their own now. So then we get to April 2nd and a game-changing announcement. President Trump announces a baseline tariff of 10% for every country and targeted tariffs based on a combination of existing tariffs, trade deficits, and the appearance of currency manipulation. For some countries, this means tariffs as high as 50%. And one week later, we get another shocker, but this time it's to the upside. There's a 90-day pause announced. The one exception here would be China. And at this point, China's tariff rate stands at 125% for U.S. goods and 145% for U.S. imports from China. So daily, we're still getting new announcements on additional goods, possible exemptions, changes to current policy, and you name it. And here we are amid this 90-day pause with the market reacting on every trade headline. And the name of the game is clearly deals. So if we look at this slide, we see policy uncertainty has shot through the roof and quite frankly out of the atmosphere here. You know, the only way forward that I see is deal announcements. The market wants certainty. And right now, executives and owners are living in uncertain times. Earnings guidance, capital expenditures, and much more are participating in that 90-day pause, essentially, and that's not necessarily a good thing. So my quick take on the risks here. If you get inflation from tariffs, it's likely shortly lived. We'll talk about that in a little more depth, but economic growth is a bigger concern with all this. Uncertainty means spending starts to stall out, both from the consumer and from businesses. And I think the Fed being too late here with growth slowing is a greater risk. This is not a 4.5% Fed funds rate economy, and that only gets exacerbated the longer this situation drags out. So agree or disagree with tariffs. I'm not going to go down that road right now, but obviously we need trade deals. They add certainty at this point when we're all built around uncertainty. And even if tariffs remain on the table, they're likely nowhere near the current levels. This is very clearly an opening salvo and a shot across the bow to start things off, whether you like that or not. And if I know anything about economic change, it's the ability of the U.S. economy to take a challenge head on and exceed expectations. So I think the Trump 1.0 playbook is still being used, but the line in the sand has drifted quite a bit. And he showed his cards in 2018, and in my opinion, he's already kind of showed some of his cards now this time around. We've heard 3 to 4 different goals for why tariffs are being implemented, but I think ultimately it's a move not just to strengthen our economy long term, but to weaken China's from our direct partnership and other trading partners. Unfortunately, there's been some significant collateral damage that may be tough to repair immediately. The silver lining here so far has been who's taken the reins and been in the president's ear the most. And a few weeks ago, the bond market sent a pretty distinct signal that things got kind of scary. But one advisor took note. Of all the trade advisors, Treasury Secretary Scott Bessent is the one I want to see at the podium or in the room the most with the president. Given his macroeconomic and investment background, I believe the previous Trump put really might be the Scott Bessent put from now on. I'd say any appearance for Peter Navarro in these negotiations just adds risk. So my faith is in Scott Bessent going forward. All right, that was a lot. Michelle, I mentioned a pretty scary day, and in all reality, a pretty scary week for bonds recently. Kind of spooked the greater markets. What exactly has been going on in the bond market?
Yeah, so the U.S. Treasury yields have swung pretty wildly over the past few weeks. Prior to the Liberation Day announcement, the U.S. 10-year Treasury was rallying in price, and the yield touched an intraday low of 3.87%. This action is pretty normal and to be expected, as investors generally seek the safety of bonds during periods of uncertainty. Then on April 4th, that same 10-year Treasury yield just surged over 4.5%, and it attracted the attention of both the Federal Reserve and the Trump administration. While Treasury flows are notoriously hard to track, there appears to be a confluence of factors accounting for the startling backup in yields. One, the tariff announcements and potential retaliation fueled concerns of higher near-term inflation. Since bonds are a fixed-rate asset, inflation eats away at their total return, so investors are going to demand higher yields. Two, there's been some speculation in the media that the rise in yields could be signaling some softening in foreign demand for U.S. bonds, though this has been hard to quantify. A third explanation is hedge fund deleveraging, and I won't go into great detail here, but there is a popular arbitrage trade where hedge funds bet that the price of cash bonds will rise relative to the futures, and they juice up the profit potential by borrowing money to increase the position size. This trade was losing money after the tariff announcement as yields rose and cash bonds fell in value. Given the leverage hedge funds use, traders faced margin calls or financing pressures. As losses mounted, traders had to sell their cash bonds to cover losses or meet funding obligations, creating, kind of a feedback loop where rising yields created more losses and further forced selling. That's probably more likely the impact that we saw, at least on that one-day move. And then finally, there's just the rising term premium. Investors are demanding greater compensation for owning longer-dated treasuries, given continued worsening in the U.S. government fiscal outlook. The reconciliation bill moving through Congress, for example, still is going to add trillions to the already burdensome U.S. debt. So the move higher in yields was likely some combination of all of these factors. The reason it was so attention-grabbing really was the size and speed of the rise in yields.
Yeah, so I'd have to agree that what we've been seeing is the confluence with all these things that Michelle mentioned, and all together it's a lot of pressure on the Treasury market that starts to feed on itself and each other in the short term. And as we'll talk about a little bit later, the flight from U.S. assets seems to be more of a headline than really a quantifiable move. Treasury data is super tough to sift through in real time, and other fund flows haven't really reflected this foreign flight so far. And even more so, we've actually seen these trade adversaries still showing up at Treasury auctions in pretty healthy sizes. So a lot of volatility and drama for what's typically a boring old yields market, to be honest. So speaking of yields and rates, I think an area we have not discussed before, but help put all this volatility in perspective, are credit spreads. In short, credit spreads reflect additional yield that an investor would want for riskier bonds compared to a risk-free Treasury rate. And they get larger or widen when times are tough. If you have uncertainty or a poor performing economy, you're going to demand more return for that risk. So we look at this left side of the slide here. You can see credit spreads have certainly picked up in the recent past and widened a bit, but they haven't really blown out, as we say. And they're still well below the historical average. And in fact, they started to narrow again in the past 2 weeks. Greater points of stress like the great financial crisis and COVID in 2022 show that spread blowing out looks a lot worse than what we've been seeing right now. But this is definitely an area I would keep an eye on, though. Bond market can be a great insight into what's coming in the stock market. So speaking of yields, Michelle, what's been going on with the Fed?
Yeah, so at the March meeting prior to the Liberation Day announcement, the FOMC voted to leave the federal funds rate unchanged at 4.25% to 4.5%. With tariffs top of mind, it's no surprise that the updated economic projections from the committee reflected expectations for, of course, slower growth and higher inflation in the near term. Following President Trump's tariff announcement on April 16th, the Fed Chairman Jerome Powell gave a speech at the Economic Club of Chicago, and the markets didn't like it at all. They didn't like the message. President Trump also didn't like the message either. Powell indicated that the Fed is waiting for more data before making any moves. Powell in his speech noted a possible tough situation developing for the Fed in which inflation is pushed higher while growth and potentially unemployment weaken. The outlook has now become extremely uncertain, he said, with fundamental changes in policy that don't provide businesses or economists with any clear parallels to study. So U.S. stocks, which, they love rate cuts, extended their losses in an already down session. And following those remarks, probably everyone heard, President Trump had a few choice words for the chair and tweeted that Jerome Powell's termination could not come soon enough. This quickly sparked concern that the president could be planning to fire Powell. Such a move would be really unprecedented, and that would seriously destabilize the confidence in the independence of the Federal Reserve. These comments further exacerbated the dislocations we were talking about in the bond market and pressured stocks further lower. So within days, of course, President Trump did disabuse this notion, saying he had no plans to fire the chair.
Yeah, it sounds like we're unfortunately back to hanging on every tweet, but my advice would be we should be looking through them. Just like Michelle mentioned, the headline risk obviously comes along with those, and acting on them can add more volatility. So let's move on to the US dollar. Another hotly discussed topic recently, and rightfully so. It's had a pretty decisive move downward. In fact, the dollar index has fallen about 10% from its recent highs just in the past 3 months. In a vacuum, sounds pretty scary, but let's zoom out a bit and add a bit more context here. So on the left side of the slide here, you have the US dollar index, and you can see the recent drop I mentioned. And along with this came talk about foreigners abandoning US investments, flight to international assets, treasuries getting dumped, and US exceptionalism ending. So intuitively, with higher rates in the US than abroad and tariffs being implemented, the dollar really should be strengthening. So how does this all add up? I think what we're seeing here is recessionary fears, general volatility, and of course, political uncertainty hitting the dollar. If we had a moderate approach to tariffs, a clear picture of what they would be, I think you would see that strengthening start to occur. But given the tenor of announcements, again, uncertainty has really rolled here. But I think this could be another area that we might get some resolution and clarity. We could see this start to trend higher. On the other hand, recessionary risk could certainly hurt those chances. And commentary over moving away from the dollar, though, as a reserve currency seems a little hyperbolic, given how ingrained it is in the world monetary and economic systems. Now, briefly, I mentioned it, but want to discuss the recent headlines of U.S. exceptionalism being over and a flight to foreign assets. Now, I don't see this as an outright head fake, but I also don't see it as a resounding or lasting move. So let's start with this slide here on year-to-date performance across the globe. It's not lost on me that international stocks have had a great start to the year. It's why we preach diversification in equities. International stocks performing well is a good thing. But if you look at the left hand of the slide, which shows us where these returns are actually coming from, you have the first two bars, which are China and the EU. Most of the returns so far have been solely from multiple expansion. In other words, equities in China and EU just got too cheap. The other half of the EU's returns have essentially come from their currency strengthening. Now, it's also not a coincidence that this trend started in early January. You have US assets outperforming international in 2024, and they've been doing that for nearly decades at this point. So you have asset managers doing annual and quarterly rebalance, and what happens? You sell what you're overweight and has performed well, which is the US, and you buy what you're underweight, it underperformed, international. Add on to this the relative cheap nature of equities in these markets, and of course they caught a bid. But what's missing in that chart is a significant earnings driver. You're not seeing this move being driven by outright high-performing and higher profitable companies at this point. That could certainly follow through and come with a resurgence of capital that's being discussed and implemented in some areas of the EU, definitely. But for now, I don't think this is an end to the powerhouse that is the US economy. This also brings me to my next point, which would be trading headlines, especially with heightened volatility that we've seen. We'll get to some actions later that you can take if volatility overall is just simply too much. And if you're okay trading less return for less risk over the long run. But trying to make short-term decisions based on headlines, how you think something might play out, or your disdain for a political decision, just adding more risk than you really need, in my opinion. You might even get the call right on a certain policy decision being made, but the market could react totally different than what you think. In fact, this market, you might be right in the morning. You could probably be wrong by the afternoon with what we've seen. So far this year, we've seen intraday moves of 3 to 5% on average. As we mentioned earlier, on April 9th, we saw upwards of an 11 to 12% move from the lows of the day. It's more than a year's return that you would miss out just by trying to get a little too cute with portfolio changes. I understand the volatility and the feelings uncomfortable at times. After all, we're talking about some pretty large policies that could potentially upend a global trade system. Volatility is never comfortable and it never feels good, but it's the price we pay to ride the equity roller coaster and earn those equity-sized returns. Once again, with all the volatility, we tend to hear a lot of this time is different. And let me be clear, the feeling and mindset is most dangerous when we take that phrase. We've come across many varieties of economic shocks in the past, and the market, and quite pointedly, the American consumer makes it through. Trying to time that, though, and thinking you can avoid that volatility altogether tends to be a losing strategy. So I'll leave it there for now until we talk about some more portfolio changes and considerations later. But Michelle, what's going on in the soft and hard economic data, and what are we expecting to see here?
Yeah, so this next slide is what we are seeing in the survey data, or what we call the soft data. It's a very busy slide, but what you can see in the lower left and upper right is that consumer confidence and business confidence is plunging. The problem is when there's so much uncertainty, consumers may pause their spending and businesses postpone capital expenditure plans. It's difficult for businesses to plan ahead when the rules of the road keep changing. In the lower right chart, you can see that business intentions for capital expenditures are falling, and in the upper left, purchasing managers surveyed in both the services and manufacturing sectors are expecting to put off purchases. All of this delay of activity is concerning and has many economists increasing the risk of a recession later this year. It is interesting to note, though, that recent hard data, or the data which actually measures economic conditions, has shown that the US economy was doing okay before the April tariff shock. Some activity measures actually look to be picking up in March as firms and consumers rush to purchase ahead of incoming tariffs. Retail sales popped 1.4% month over month in March due to strong vehicle sales. Manufacturing production increased 0.3%, and US initial jobless claims remained historically low at 215,000 last week. So while the hard data has looked okay so far, soft data or survey data, not great. In the most recent CapEx forecast survey from CEO Magazine, forecasts of capital expenditures 12 months out have moved dramatically from January to April, much lower. Also, expectations for hiring have moved lower as well. For all of these reasons, we are more worried about growth than sustained inflation, especially if the Fed is slow to respond. The thought being that in the second quarter or third quarter, we're likely to see the payback from the most recent rush to purchase ahead of tariffs, and then the purchase delays indicated from the survey data will all just kind of indicate that there's weakening demand coming later in the year. We do believe that the tariffs, to the degree that they stick, are a level shift up in prices and won't manifest, ultimately as persistent inflation. The market will have to absorb the blunt force reset in prices, either as a one-time increase in prices or a hit to margins. Bottom line, the rate of change shouldn't move meaningfully higher over the longer term. It is even possible that consumers may have just balked at the higher prices, especially with sentiment already so low. If consumers resist price increases, the tariffs will hit either foreign or domestic profits, so that means margin compression for companies. Since profits are a key leading indicator of business spending, and that includes labor, the US employment rate may end up rising. With US monetary policy still quite restrictive, demand should slow. So if demand does slow and employment starts to soften, we believe the Federal Reserve will be cutting rates possibly as early as June. So while we believe tariffs will be negotiated lower, some level of elevated tariffs are in our future, and other boosts will be needed to counter the effects. One key U.S. government support available includes, of course, extended tax cuts. Also, as I noted earlier, the Fed could help a growth shock by lowering interest rates. And finally, the private sector could bail out the public sector with productivity gains, which means more growth with less inflation. We believe productivity holds the key to the U.S. being able to navigate the current macro environment without a bout of stagflation, which is characterized by slowing economic growth, high unemployment, and rising prices simultaneously. How the tariffs are passed through is another issue. Some of these one-time bumps may be absorbed by companies hitting their bottom line. That means lower margins, while other companies may try to pass through increases to customers. Either way, tariffs are likely to pose a headwind to the economy. The hit to growth will depend on the ultimate magnitude and duration of the tariffs. So we've talked about the softer survey data and how consumers are feeling. Dominic, what are you seeing in the actual health and balance sheet for the average consumer?
Debt service ratio has just moved sideways, as you see in the top right of the slide. And as far as any trends in delinquencies, auto and credit cards have plateaued. That was a previous concern as they were starting to trend up. Mortgages, on the other hand, have continued to trend up, albeit to a more normalized level still. My inkling here is you have a lot of recent homeowners who stretched a bit in hopes of refinancing with lower rates, and that just has not happened yet. So if we can get rates down, we can get some relief in the mortgage market. And not only do I think we see the real estate market start to pick up, but you see some relief in those delinquencies. All right. Overall, the consumer looks great. But like we saw previously, they do not feel great. This is not the first time that we've discussed kind of the discrepancy between hard data not agreeing with the soft data. I would say my personal trend has been not to rely on sentiment surveys, especially consumer surveys, too much anymore. Beyond that data, how that data is collected in the first place, I think it's also easier to have these bearish outlooks with the nature of our financial media and headlines. But then spending and capital allocation really tells a whole different story. So I will say recession odds have picked up, and pointedly with the potential for corporations to have to act depending on tariff clarity, whether that is increasing prices, laying workers off, or a combination thereof. The health of the consumer is paramount to our economy. Recessions are not good for anyone, so any creep in these numbers should be a warning signal. The hard data in consumer spending is one of the indicators I would definitely watch the most for signs of cracking in the economy and leading to potentially something bigger. So, Michelle, what's going on with GDP? Quite a big announcement this morning.
Yeah, there was. Yeah, I'll just add to what Dominic was just saying, that consumers typically spend at the growth rate of income. So the strength of the market, of the labor market, matters. And we will get our first post-Liberation Day labor market reading this Friday. So investors will be looking closely to see if there's any weakness in that data. What we've been hearing so far is that while companies aren't hiring as they may have expected, they are not laying off workers in large numbers just yet either. And as Dominic led with in other very important data out this morning, fresh off the presses, first quarter GDP, which measures the value of all the goods and services produced in the U.S., it shrank at a seasonally adjusted annual rate of 0.3% in the first quarter. So not a great looking headline, but there's a lot of detail in the details, I guess. Much of the first quarter's dismal economic performance is due to a huge influx of imports that came as companies and businesses attempted to pull forward orders to avoid the impact of President Trump's tariff increases. Goods imports spiked at an annual rate of 50.9% the first 3 months of the year, and the nation's trade deficit widened by 14 trillion, which is huge. Imports count actually as a subtraction in the calculation of GDP and accounted for a drag of a whopping 5%. That is a huge reversal from the fourth quarter when imports were actually significantly lower. So given the outsized trade distortions in the data, the contraction in the growth may not be viewed as negatively as the headline might, given the potential for that trend to reverse in subsequent quarters. A more telling economic gauge that captures consumer and business spending but strips out trade, inventories, and government outlays is called final sales to private domestic purchasers. It actually grew at a fairly sturdy 3.9% annual rate. Consumer spending slowed during the period, but was also still positive. Personal consumption expenditures increased 1.8% for the period. Business investment actually spiked quite a lot, 9.8% after falling 3% in the previous quarter. Company purchases of computers, delivery trucks, factory machines, and other equipment grew 22.5%. Business investment leaped largely because firms imported capital goods before tariffs take effect. So messy number for sure, but suffice it to say the outlook is murky. We have seen, though, previously, during difficult times, U.S. companies be very able to pivot and innovate in the face of obstacles. You know, while Dominic said the odds of a recession are rising, we do not consider that our base case yet. Again, this will depend, a lot on the tariff negotiations, as we will hear coming days and weeks. Okay, switching gears here to corporate earnings. Stocks are in the heart of earnings season this week, and according to FactSet, roughly 36% of S&P 500 companies have reported first quarter earnings, with 73% of them exceeding analyst estimates, better than what investors had feared given all the volatility and uncertainty in the first quarter. Also, on a positive note, companies have beaten earnings estimates by 10% on average, which is better than 5 and 10-year averages. This week will bring some key insights into the biggest of the big tech firms, with 4 sets of earnings results released over the coming days. Tesla and Alphabet have already reported, and NVIDIA is not due till the end of the month. So this week actually belongs to Microsoft and Meta. Both will be reporting their earnings after the close today, and Amazon and Apple after the market closes on Thursday. In the chart here, you can see that after a fairly dramatic repricing of these stocks lower, the Magnificent Seven carry a PE ratio, or a multiple to earnings, not seen since 2023. These companies have fortress balance sheets and a solid long-term secular trend. So for long-term investors, there's a shot at owning some of the best companies in the world cheaper than they have been in some time. In our view, innovations in technology and AI are even more important than ever as companies search for ways to become more efficient and protect margins in the midst of geopolitical tensions and tariffs. Okay, so this takes us to portfolio construction and opportunities. Diversification remains a cornerstone of a resilient portfolio. As Dominic mentioned earlier, shorter duration core bonds played a stabilizing role in Q1. The U.S. aggregate bond index was up nearly 3% in the first quarter. Additional sources of diversification, such as exposure to international and emerging markets, have also contributed positively to performance. International has outperformed the U.S. this year, supported by fiscal and monetary stimulus, alongside a weakening dollar. Europe notably shifted its economic priorities, with Germany implementing major defense spending increases and structural reforms aimed at bolstering both military and economic strength. Allocations to real assets, including real estate, utilities, and infrastructure, have also provided support in the portfolios. Looking forward, we continue to like big cap tech, as I had mentioned. We also like some thematic sectors like cybersecurity and communication services that tend to be more recession resistant. Real estate and small cap are very cheap on a relative basis and will benefit from Federal Reserve rate cuts that we think are probably coming pretty soon. And finally, private investments continue to be a valuable component in managing volatility and enhancing long-term portfolio resilience. So we're feeling good about our diversified portfolio. But that being said, Dominic, what do you advise clients to do if the volatility just feels like it's too much?
Apologies. Seems like our presenter's having some difficulties with his microphone. Give us one moment here.
Any better?
Yes.
Okay. All right. Sorry about that. So going to double down on saying I understand volatility like we've seen is not comfortable. I'm not downplaying that. And truth is, though, making drastic portfolio changes during times like this needs to be well thought out. So a few considerations for anyone who is worried or thinking about making adjustments. First, why are you making the change? Are you close to retirement and realize there's just too much risk in your portfolio? Okay, that totally makes sense. Sequence of return risk is probably a huge factor for you. Are you realizing that in general, you're just not comfortable with as much equity exposure as you currently have? Okay, times like these tend to be somewhat of a Rorschach test for us all, and we're all going to respond differently. But these decisions need to be made for the long term. So trying to plan like this just for 6 months or a year or for the dust to settle is pretty dangerous. There's no all clear alert or a time to buy alarm. And like we've seen this past month, the market will turn on a dime, one direction or the other. And it's relentless when it's not going to let you back in. So not to beat a dead horse, but this time is not different. The reason might be different. Who you want to blame might be different, amongst a myriad of other things. But how the market reacts and how you should react shouldn't fundamentally change. So far we stand less than 10% down. We nearly entered a bear market 20% down. It can certainly fall further. But as you see here on the chart, this is not the first time we've experienced this. Pullbacks, corrections, and bear markets are all a common part of investing, but how you act is the real test. We actually just did this drill in 2022. It's a bit of a slower grind, but it's for different reasons. So my first consideration, are you rebalancing in the first place? On the slide here, you see a portfolio that's 60% stocks and 40% bonds. Pretty common allocation for most balanced investors. What you see is a 7-year run, and what happens if you don't rebalance at all? You end up with 73% stocks and 27% bonds. Now you have 25% less exposure to your bonds, which are supposed to be your balance and your less risky assets. And you come across a year like 2025, and you have more volatility exposure than you really planned on. So the lesson in short here is rebalance along the way. It's tough to cut what's working, but that's really how this works and how you maintain your long-term targets. Second consideration, I don't have a slide for it, but take stock during times like these. Maybe you don't feel like you need to react right now, but you want to, and you can ride out the storm. And you can make a longer-term decision when things feel better because you don't like the lack of sleep. If you can wait and volatility falls, which we've seen the VIX drop from 55 to sub 20 just in the past 2 weeks, then have a discussion with your financial planner or advisor about what lowering your risk does for you. Might mean less spending, but if you're all right with that and the trade-off that it comes with, maybe that's the best adjustment that you need to make. Third consideration, more of a warning, is simply that trading during times like these for any reason is going to add its own risk. So say you want to cut your equity exposure in half, and it's for the long term. You're not going to change that. I discussed the heightened volatility index earlier, or the VIX. When this VIX spikes, intraday market moves get super large. So even if you want to rebalance for the right reasons, you can make that decision, and the next day you might not even need to with the volatility swinging one way or the other. You could also decide to enter the market, but between committing to that and actually buying, you have a 5 to 10% swing in the index like we saw for multiple days in April. Even rolling over a 401k plan can add a ton of risk with the way that markets are operating with heightened volatility. I would say keeping an eye on the VIX as a gauge to measure that volatility and making these large decisions once it's calmed down is probably the smartest move if you really need to make an adjustment. And as Michelle alluded to, look at your diversification. Do you need to add some additional asset classes as a way to lessen your risk? I already discussed international doing well this year. That's one way. You could add fixed income if you don't have any, or alternatives like commodities or real assets. Depending on your risk tolerance, if you want to be illiquid, certain private investments are another option. And that's what we're going to wrap up with here. So, Michelle, what do opportunities in private assets look like?
Yeah. So with all the uncertainty that's out there, investors who are willing to venture outside of the public markets can leverage a range of different private assets to diversify their portfolios and reach their desired outcomes. As you can see on this next slide, alternative assets can offer low correlations to public markets, diversified income streams, and enhanced long-term returns. Real assets, shown towards the left, such as real estate, infrastructure, and transports, tend to be less correlated to a traditional 60-40 portfolio while providing robust income. Private equity and venture capital, towards the right, can provide higher total returns but come with higher correlations to public markets and less income generation. Bottom line, when considering asset allocation, adding a sleeve of alternatives can help long-term investors achieve strategic goals through higher alpha, better diversification, and enhanced income. Dominic, what are we seeing in specific opportunities in private investments right now?
Yeah, so before I go into some of the asset classes we like, just a quick reminder that private investments come with different risks than public markets. The major difference is a lack of liquidity. So working with an experienced advisory team on allocating privates is very important. The other consideration that we see here on the screen is manager selection. Private investments are predominantly done through a general partner. That partner's expertise is critical when allocating to these assets. You can see here that on the left side, allocating to public market assets, you have smaller dispersion in returns. So you kind of know what you're going to get, and that's largely to being tied to benchmark returns. On the right side, quite the opposite. Private market returns have huge dispersions. Picking the right manager is quite crucial, as you can see, if you want to achieve those outside returns especially. So what do we like right now? First asset would be real estate. Commercial real estate has been it's seen a considerable amount of repricing over the past few years. Certain areas have rightfully been impacted, like metropolitan office markets, but other trends in e-commerce, an aging population with a lack of healthcare facilities, and a greater need for multifamily and student housing are all providing good opportunities. Infrastructure is still one of our favorite opportunities as well. Not only a major diversifier, but sources of revenues, and the assets are a great way to dampen the potential impact of a recession, inflationary risks, and often have greater tax efficiency. So this might be a great opportunity to tune out the noise. Then private equity. Still think private equity has a lot of opportunity, but definitely the asset class you need to do the most due diligence on. With M&A deals being delayed here, you really want the right exposure to the right markets, given capital has been tied up a little bit longer than expected. I think the opportunity in the short term, though, is private equity secondaries. So you have general and limited partners that need to free up some capital, not by choice. So you might get some attractive pricing, and that's what's known as the private equity secondaries market. Now, other trends in software and AI are attractive again, but I would preach due diligence in finding those strategies within the managers.
Yeah, thanks, Dominic, and lots of good information there. And finally, to follow up, the outlook for the economy is clearly uncertain right now, and we believe we are in for more volatility for sure. That said, we thought we would wrap up here with some reasons to be optimistic. The Liberation Day tariff announcements were no doubt a dose of shock and awe, and the markets reacted accordingly. However, since the markets have rebounded pretty nicely as the administration seems keen to do deals, the S&P 500, depending on the minute, I suppose, is up about 10 to 11% off its lows, and the bond yields have stabilized. The president has hosted many company execs to hear about the challenges of the tariffs as proposed. Earlier this month, the White House excluded major electronics and categories such as semiconductors from the steepest round of tariffs. Just yesterday, concessions were made to automakers, and Secretary Bissett said this week that the administration is in close talks with 17 countries. The media has leaked them to be, such as India, South Korea, Japan, and Vietnam. So we think deals are coming. As we mentioned previously, the economy came into this moment in a good position with reasonable growth, declining inflation, and strong employment. And we're encouraged by what we're seeing in earnings season so far. We've even gotten a little bit of dovish Fed speak. I'll just wrap by saying at a recent event, Fed Governor Christopher Waller voting members said that, I expect the inflationary effects of tariffs to be temporary. Their effects on output and employment could be a larger concern, in which case I would expect to favor cutting the FOMC policy rate sooner. So we do believe the Fed will be cutting rates by this summer.
So it sounds like we're in somewhat of a holding pattern, but a lot of possibilities for upside potential. With that, I think we're at time here, so I'll hand it over to Talia.
Awesome. Thank you, Michelle and Dominic, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate our performance upward. Thank you for joining us, and we hope you'll join us again next time.